The truth is that up until recently, the economic environment, certainly the economic narrative, did not favor gold. From like 2012, 2017, 18, 19, gross underinvestment. That is now beginning to be felt in the production. I think the timing is absolutely right for the commodities generally, and they've been cutting rates before they have inflation under control. We're nowhere near a top of the gold price. We have a lot further to go in the gold. There's a high possibility that the Fed will reinstitute QE, and QE will be just wildly bullish for gold.
Adrian Day, financial analyst and CEO of Adrian Day Asset Management. It's a true pleasure to host you on Palisades Gold Radio today.
Well, thank you very much, and thank you for having me back.
Yeah, really excited for this one, Adrian. The last time we spoke was in September 2025. Back then, gold was trading at around $3,800 an ounce. And I started off that interview asking you whether there was still reason to be bullish on gold back then. I believe your answer was, oh, absolutely. You've been proven right, of course, by the market. Gold went up to $4,400 an ounce. It has pulled back a little, now around $4,200 an ounce, a bit above that. So I would love to update that question, Adrian. Is there still reason to be bullish on gold today, early December 2025?
Oh, absolutely. I think so. Gold in September, and October, gold just moved too fast, and we know that. Certainly in October we were saying that. But if you look at where gold is right now, all of the fundamental drivers of gold, all of the fundamental things that drove gold up over the last 3 years, frankly, are still in place. The only thing that's a little bit sort of different perhaps is the Chinese retail buying, not the official buying, but the Chinese non-official buying, which got into a bit of a mania in October and has since subsided somewhat. But if you look at the main drivers, central banks, for example, they're continuing to buy. Yes, less than they were at the beginning of the year. It's come down. But still on a 5-year, 10-year basis, they are buying very, very significant amounts. And I think that all of the reasons that they've been buying remain in place, so I don't see that changing. We know that Tether is a new entrant into physical gold buying. My own sense of them is they're going to continue to be buying fairly aggressively, in the near term. And of course, the reason that wealthy individuals, wealthy families, whether they're in the Middle East, Europe, or North America, have been buying gold, concern about the fiscal deficits, well, nothing that has happened recently would change one's mind on that. So I think all of the reasons people have been buying gold remain, and add to that one other factor that we've seen in the last few months since September when we talked, and that is that central banks around the world, other than Japan, which always seems to march to a different drummer, but have been cutting rates, and they've been cutting rates before they have inflation under control. So we run the risk of inflation. I'm not looking at inflation running away anytime soon, but we certainly run the risk that inflation is going to be stubborn and going to inch up in the face of lower rates. So yeah, no, I'm very bullish on gold.
Always great to hear that, Adrian. And of course, the fundamental reasons like you outlined, if you look at them, one of them could be currency debasement. The other could be central bank buying because of diversifying away from the US dollar because it's losing its trust. Or you could hedge against uncertainty. If you look at all those reasons separately, it seems to be firing on all cylinders currently.
Absolutely, absolutely. I mean, I think the main concern in the immediate term is, first of all, as I said, gold just moved up too fast in September and particularly October. And if you look at Chinese non-official buying, it just shot up. It was almost exponential in October. And so we were overdue. We were due for a pause. To be honest with you, I think the pullback that we got, well, first of all, it was less than I was expecting. but it was a pretty modest pullback. And of course, since that pullback in the beginning of, at the end of October, gold has actually, steadily moved back up. So the question to me is, have we had the correction, the pullback? Because it wasn't even a correction, technically speaking. But have we had that pullback sufficient to wash out all of the weak hands? I'm not sure we have. But on the other hand, it is very clear from gold's action over the last 6 weeks that there is a lot of pent-up buying on the sidelines. And, human nature's a funny thing. People that didn't buy at 3,000 because they thought they'd wait for 2,800 and didn't buy at 3,200 because they thought they'd wait for 3, and all the way up didn't buy because they were waiting for that pullback. They were happily buying at 4,000 because it had pulled back. So I think there's a lot of buying on the sidelines to offset what I just said. The only fundamental factor in the near term that should give us a tiny bit of pause would be the Federal Reserve meeting, in 10 days' time, 9 days' time. The Fed funds futures, the betting markets now have like an 85-86% odds on a rate cut. That is already priced into the gold market, in my view. And so the risk is that if they don't cut, the market is disappointed. That's always a risk. So I'm not making a prediction that they won't cut, but I don't think a cut, certainly not 100%. The Fed would have every reason to say, we cut in October, let's see how that plays out. We have another meeting in January, and we don't have any economic data to make a decision on, so let's just wait and see. That would be a reasonable and a very Powellian, a very sort of typical thing for Jerome Powell to say. I'm just saying if they don't cut, there's a risk of gold being disappointed. But beyond that, I frankly couldn't be more optimistic. And of course, as we know, the gold market is a lot more than the US and a lot more than the Federal Reserve. In the US, people tend to be very US-centric, and you focus on things that just affect the US. But the Fed is a big factor. But if you look beyond that, we've got a new Fed chair coming in who we know is going to be dovish and for lower interest rates. We'll have new Fed members. So this time next year, the Fed will be a completely different Fed with a different outlook, a very dovish outlook. And frankly, I think we've got a high probability that at some point in the next 3 or 6 months, the Fed will reinstitute QE. They might call it something different, but they've already stopped QT, right? Officially, they have stopped quantitative tightening. And if you look at the last 6 weeks, you find the data comes out weekly from the Fed, but if you see as many weeks where the balance sheet has increased in size than where it's decreased in size, and that's during a period when QT was still officially the policy. So I think we have there's a high possibility that the Fed will reinstitute QE, and QE will be just wildly bullish for gold.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Wildly bullish for gold. Adrian, something that you track a lot, I believe, is the generalist investor moving into gold. Of course, talking gold cycles now and investor behavior. Why is that an important step in the cycle? What would it tell us, and where are we standing today on the generalist investor front?
Yeah, well, traditionally, historically, the generalist investor has had an allocation to gold. In the US, it's been less than it has been in Europe and the rest of the world, but in the US or in North America generally, it's around 2% historically, and globally it would be more like 4% as the average exposure to gold. I think the key for me is not that the generalist investor, and particularly not the North American investor, is so important to the gold market. It's just that it's another source of buying that we really haven't seen in any significant way this year. I mean, I remember when I first, and it's not just individuals, it's not just retail. I mean, when I first came into the business, and all the way back as recently as 2008 and 2010, in fact, you could look at any mutual fund out there, US big cap, global value, emerging markets, that all have some exposure to gold. That all have some gold, just as they probably all have, some tech and some consumer staples and so on. And if you look at funds today, very, 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 you can count on a hand the number of generalist funds that have exposure to gold. So that's just another source of buying that will come in at some point. Now, generalist investors, painting with a broad brush, will tend to be price followers. They're not price agnostic, and they're certainly not, price inelastic buyers, but they won't buy when things are really, really cheap. They will buy when the prices are moving up and there's some momentum behind them. So I'm just saying that's another source of buying that we really have yet to experience. I mean, year to date, we're still seeing a good way of looking at that, apart from looking at the holdings of mutual funds. That's one way of looking at it. And there's just basically nothing. Another way of looking at it would be, surveys that people take, and that shows meaningfully less than 1% exposure among individuals, among financial advisors, even among family offices that tend to be a little bit more at the cutting edge. And then the other way to look at it, of course, is flows into the GDX. Because a lot of particularly retail people, not so much funds, but a lot of retail people who hear gold's going up and they want to buy a little bit, they're going to buy the GDX or another gold fund. And the funds just are not seeing inflows at the moment. I mean, they're simply not seeing inflows. I just think that's another source of buying that has yet to come in.
Incredibly interesting, Adrian. And is it then fair to say, if we were to see the United States go back into quantitative easing, lower their rates significantly, like other Western countries have already done, Europe, for example, and then for this generalist investor to potentially move into gold over the next few months or even years, you could have two engines further driving this bull market higher?
No, absolutely. That's the point. You would then have another engine driving the gold market. In and of itself, it's not going to be, I don't think it's going to be the main driver. In North America in particular, because in North America, they don't have this history of gold as an asset of last resort, such as they have in Hong Kong with the Chinese coming over the border in 1949, or Vietnam, people who got out of Vietnam just carrying the gold what do they call those gold wafers that they roll up? Tails, the gold tails that they literally stuffed in different parts of their body to get out of the country, or Germany, or where gold actually saved you. There's not that history in North America or in England for that matter. And so in North America, people will tend to buy gold not as an asset of last resort, but they will tend to buy it when the economic environment favors gold. And the truth is that up until recently, the economic environment, certainly the economic narrative, which I think was partly wrong, but the narrative did not favor gold. And we've had a strong economy, high interest rates, low inflation, and notwithstanding the fact that the dollar fell in the first half of the year, on a 5-year basis, still a reasonably high dollar, plus a strong stock market. So that is precisely the wrong environment to get a North American investor interested in gold. But with the dollar going down, with interest rates coming down, with inflation, moving up, and with the economy weakening, and with increased volatility in the stock market, that is the environment that will see North Americans get interested in gold. So we're seeing that shift. We're not there yet, excuse me, but we're certainly seeing a shift in all of those factors towards an environment that is more conducive for gold. And I think the one thing that will really get, absent a series of very high inflation numbers, CPI numbers, but the one thing that will really get North Americans to look at gold will be if the S&P breaks down, and the big high flyers, if they break down.
This cultural tie that you've outlined here with gold, Adrian, is incredibly interesting, because what I hear a lot of North Americans and Europeans talk about is this debasement trade. They're predicting huge waves of currency printing. They're hedging their bets or going to assets that would benefit in such a scenario. And this implies getting out again in the future. Well, if you're predicting a lot of debasement or, a structural shift potentially, you would suspect staying in bullion might be the trade instead.
No, that's a really good point. Absolutely. And we are seeing now, when I talk to people about debasement, they say, oh, well, every other currency is worse. I said, well, you're missing the point. We're not talking about the dollar necessarily going down against other currencies. We're talking about all currencies, or most major currencies, being debased. And so it's a look for an alternative asset that isn't at the whim of any particular government, that isn't anyone else's liability, an asset that's not a liability of someone else, and that obviously, is gold. That's why central banks are selling their dollars and they're buying gold. They're not selling the dollars and buying euros or buying the Swiss franc. They're buying gold. And I think you're going to see that trade from individuals as well. You've seen it with the central banks. You're seeing it to some extent with very wealthy families and sophisticated investors, like Ray Dalio in the US, and there's some in Europe and some in the Middle East, but wealthy and sophisticated investors. But you will soon start to see that thinking will start to permeate, the massive investors pretty soon, I think. Because it's very clear what's happening. There's hardly a country around the world that wants a strong currency right now.
And there's hardly any country in the world that doesn't have enormous government debts compared to their GDP.
Absolutely. So yeah, and so gold is the obvious candidate there.
Definitely.
And that's regardless of whether there's any policy on the part of the U.S. government to sort of accumulate gold and then revalue it, or China accumulating gold to back the yuan, or anything like that. Not even getting into those, just on a plain what's happening now, not what might happen in the future. What's happening now, currencies are just losing their purchasing power without any end in sight.
That inevitable currency debasement thesis is very much clear. I would love to take you into a revaluation or remonetization thesis just for a second, Adrian. Talk about the future. Do you think it is likely for you and I to see that anytime soon over the next few years or even a few decades, either the US doing so or BRICS doing so through a settlement currency? It seems like the incentives are such that countries around the world would want to clean up their balance sheets.
No, absolutely. I think you could see gold. I mean, gold will play a role. I think, but I don't think we're going to see a major currency that it certainly is 100% backed by gold. I don't think we're going to see that simply because the price that will put on the gold would be, so far away from where we are right now. But I think gold could be a component. And it's a bit like, there's that famous phrase in Hemingway about how do you go bankrupt slowly at first and then suddenly. And I think that's what we're seeing. We are definitely seeing with the BRIC countries moving away, bit by bit, in their reserve assets and in the currency of account that they use for global trade. I mean, it was not so long ago that something like 90% of global trade, even if the US wasn't involved, took place in dollars. Saudi Arabia sells oil to China and it's settled in dollars. And yes, the overwhelming majority of global trade is still settled in dollars. And something like 50% of global reserves are still held in the dollar. But those numbers are dramatically less than they were 5 and 10 years ago. So I think we're slowly seeing that shift, both in the trade and the reserve asset, away from the dollar as the only reserve asset. And so, these things take time. They take a long time. And at the moment, there is no other currency that could replace a dollar, right? So I'm not suggesting that, we're going to wake up next year and a yuan or renminbi is going to be the global reserve currency. But I think over time, people are going to move away from the dollar. And to the extent that they move away from the dollar, particularly on a reserve basis, some of that is going to move into gold.
Incredibly interesting, Adrian, and I could continue asking questions about gold and picking your brain for hours. I would love to transition to silver for a second. We've seen quite an explosive move higher up until, I believe, about $58 an ounce. What do you think was fueling this meteoric rise? Yeah,
well, of course, the price of silver had definitely lagged the price of gold over many years, and the silver price only just exceeded its 1980 high in nominal terms, whereas of course gold had exceeded its nominal 1980 high years ago. So silver definitely lagged. I think when you start to get interest in the precious metals, particularly North America, a lot of that interest just goes into silver because there is a much richer history of silver in the United States to begin with. And of course the silver price, an ounce of silver is a lot less than an ounce of gold and so on. So people can afford to buy 1 ounce, 10 ounces much more readily than they can buy gold. But silver, there's a couple of there's lots of interesting things about silver, but you don't have the supply response to changes in the price of silver are very, very tenuous indeed and very delayed. Now the price response to changes in the supply response to changes in the price of gold and other commodities are delayed. They're not as strong a price response as, say, price of shoes goes up and you start making more shoes. But with silver, they're particularly tenuous because of course most silver, for two reasons. One is most silver is byproduct, right? And so most of that, 75% is byproduct, and most of that is byproduct of base metals. It's not byproduct of gold. And so, again, to take an example of a zinc miner in Peru who gets 8% of his revenue from silver, doesn't decide to open a new zinc mine because the price of silver's gone up. Similarly, on the way down, he doesn't close his mine down because his 8% byproduct silver has lost half its value. So there's no price response, no production response. And then similarly, of course, or at the same time, we don't have huge stockpiles of silver. If the gold price were to move to $10,000 next week, I will guarantee you that some of the people who said I'm never selling my gold will sell their gold. It's ready, it's available to sell, right? There's stockpiles, large stockpiles, because all the gold that's ever been mined, as you know, still exists. When we say all, we really mean 98% or something. Some of it's in teeth, and it wasn't, you know, the undertaker didn't grab it before they buried the body, but most of it still exists, and it exists in vaults, whether it's central banks or whether it's individuals, but it exists and is available for sale, potential sale. But that's not the case with gold, with silver. And so when you get these moves in silver, there is no huge supply coming on to meet that. And silver buyers tend to be sticky buyers. They tend to be sticky buyers as well. So, yeah, I think we could easily see silver in the next 6 months or so. I think we could easily see silver outperform gold and move up, you know, to the $80 range, even higher. I mean, for silver, looking back to 1980, for silver to be at a comparable price for gold today, it would have to be something just over $200. So we're a long way from that.
Do you think drawing that historical parallel with the 1980s would be fair today for silver as well?
That's an excellent question. That's an excellent question. No, I don't think it would be completely fair because so much has changed with the silver price over the last 50 years, 40 years, and even beyond. You know, when I hear people talk about this gold-silver ratio going back to 1850, it's sort of meaningless, in my view. Or at the very minimum, at the most, it's just one indicator that should be put along with a lot of others. I don't regard it as sort of a sole indicator to trade on. As we know, I mean, everybody knows that the demand circumstances for silver have changed dramatically over the last 50 years. You know, the photography demand isn't there anymore except for very high-end, you know, MRIs and very high-end imaging. On the other hand, we've got a lot of demand in solar panels. But more importantly than that, I think, is on the supply side. I mentioned 75% was byproduct. You go back to 1980, something like 75% was primary. In other words, it came from primary silver mines. And of course, the price response with a primary silver mine is different, you know, from the price response from a zinc or lead mine. So the fundamentals, the fundamentals and the structure of the market has changed meaningfully. So I don't think it's completely fair. But at the same time, if market participants think something, then it becomes important. And there's no question that the silver price is like the gold price. I mean, we can, that's a fact. And there's absolutely no, there's no question that the silver price today has not kept up with inflation since 1980. So I think that is something that will definitely drive retail buying into silver and into silver over gold. So it becomes true.
Yeah, no, that makes sense. And of course, also something interesting with silver would be oftentimes it's a relatively small component of the input cost of a product. So even if it were to double in price, the impact on the end product could be relatively small, couldn't it?
No, that's true, but that's true. And also, if you look at things like solar panels, for example, they're becoming much more efficient, meaning they're using less silver than they used to use, but they're also lasting longer than they used to use. So that would argue both that it's fairly price inelastic, but equally the demand is not going to be as great as maybe some of the projections were, 10 years ago.
Okay, well understood. Adrian, we recently saw a multi-hour disruption at the CME, the metals exchange. Do you think this is just coincidence on a day where silver performed relatively well, or is there foul play at hand?
I'm not a conspiracy sort of person, to be honest. I will say that I am willing to believe that governments and pseudo-government institutions will do anything. There's nothing that they could do that I wouldn't believe, but my first reaction is always to look at things at face value without additional evidence, to be honest. So I'm not sure that there was foul play there. I mean, look, let's face it, the exchange has the ability, and they've done it in the past more than once, they have the ability to change the terms of the contract halfway through. So why not just do something that they've done before without, I don't go, I'd want more evidence before I even dreamt of that.
Okay, well understood. Adrian, I would love to transition to an area where you're spending a lot of your time, the gold miners. Talking about the value proposition that's currently still out there in the miners. If you look at the almost, I would call them super majors, the Agnico Eagles, the Barrick Gold, the Newmonts, the really large gold miners. Is there still a lot of value to be found if you're looking there?
Oh, I think so, definitely. And I would certainly argue that for someone who's new to the sector, they should definitely start with some of those big ones, and not just the miners like Agnico, but also the big royalty companies like Franco and Wheaton. For a couple of reasons, I'll say that. Number one, the gold price is, in my view, the gold price still has we're nowhere near a top of the gold price. We have a lot further to go in the gold price. Number two, the valuations of the gold miners are still very, very good. On some metrics for some companies, you're trading in the lowest 10 or 20 percentile of valuations, not price, valuations, for the last 4 decades. You look at Agnico, for example, and Agnico's price to free cash flow, which perhaps would be my favorite metric for the gold companies. I mean, I look at a lot of different metrics, but that would be my favorite one. Yes, their price to free cash flow has gone up from what it was at the end of last year, in December in last December. But it is lower today. Their price to free cash flow is lower today than it was in every other one of the last 5 years. Now, how can that be, people say, when the price of stock has done so well? Well, when the price of gold moves up, and it means that the value of your reserves moves up, and they move up on a leveraged basis, because, of course, if the price of gold goes from, let's just say, 3,000 to 4,000, it's not just a 33% increase in the value of your reserves, but companies will start to value their reserves at a higher price. I mean, some companies are still valuing reserves at $1,700 and $1,800. So when they do their year-end reserves with the gold price of 4,000, you know that they're no longer going to be valuing reserves at $1,700, right? So number one, you have that move up in the price of gold, but also as you value your reserves at a higher price, you can bring in more of your resources into reserves, and they move up in the confidence scale. So it's leverage. The same thing happens to your revenue. If the price of gold goes from 3,000 to 4,000, well, it doesn't mean that your revenue simply goes up 33%. I mean, if your costs are not moving up at anywhere near the same rate that the price of gold is moving up, which is true at the moment, it might change at some point, but at the moment, for the last 3 years, that's certainly been true. It means that your cash flows are going up, and your cash flows are actually moving up at a faster pace than the price of gold is going up, because you're able to produce more, bring more ounces in, and so on and so forth. And so the free cash flows today that the company's having, for most of them, they've already eliminated their debt, for most of them, or at the very minimum, let's say they're net cash positive, right? Net cash positive. That means all of that margin is going to your bottom line, basically. And when companies have all-in sustaining costs of $2,000 and the price of gold is $4,000, that's a very, very nice margin. And so, so you have that sort of, it seems perverse or it seems like an anomaly, but you have valuations lower today than when the stocks were trading at, 30 or 25% of their current price.
Adrian, that was definitely a masterclass on leverage that the miners present towards the gold price. If you were to step one tier down in size, not necessarily quality, but size, and you go to the Equinoxes, the Alamoses, the Endeavors, in that tier, is there still a lot of value to be found as well?
Oh, I think that is the area, and I'm not talking about every company you mentioned, but I think that is the area where there is the most growth potential. If you're looking for the most growth over the next year or 2 years, I think that is the area you're going to get. Remember, when generalists first come into the sector, they tend to come into the bigger stocks, right? So, the Fidelity or Schwab or Vanguard or whatever, US big cap fund who wants to take a 5% position in gold, they don't buy Ajax Exploration. They probably don't even buy Equinox. They buy Newmont or Barrick or Agnico or Franco, and they stick with that. And when the dentist in Oklahoma calls his financial planner, and he knows nothing about gold, and the financial planner knows nothing about gold, but says, hey, I think we should have some gold. Well, again, they probably just stick it into a fund. If the guy works for Fidelity, he's going to be in the Fidelity Gold Fund, and if he doesn't work for Fidelity, he's going to go into the GDX. But if they do buy individual stocks, again, it's going to be the big cap stocks that they start with. And so, given that the generalist and the retail in North America is really not into gold yet, other than dedicated gold investors, then they're going to start with the bigger cap stock. So I definitely think there's a lot of interest there. But as the market develops, when those stocks start to get more expensive, people start to look down the food chain. And the next group to look at would be the B2s, the Equinox, the ones you just mentioned, Orla, Discovery, etc. That will be the next group of companies to look at. Companies that are preferably multi-mine. I don't like smaller companies that only have one mine, but multi-mine companies, that have a pipeline and that have potential to grow. And I think that's the next thing to buy right now. Yeah, definitely.
All right, well understood. Thank you for your take, Adrian. I would love to talk about M&A and financings for a second. Adrian, what is your perspective on the health of the market there? And perhaps you can also offset this against dilution. Are we doing too much too quickly? Or are we being patient and prudent enough?
Yeah, somewhere between. I certainly don't think, at different times over the last, 20 years, I have railed and ranted against the excessive dilution. I don't think we're quite there at that point yet, and I would say that most of the you're getting a rash of financings, no question, say all year, but particularly the last 3 or 4 months. There's been a rash of financings, but broadly speaking, and by and large, I'm not seeing sort of stupid financings, for really bad companies. I mean, generally, when you look, we're raising money for, good quality companies for specific purposes, generally speaking. I mean, that will change. There's no question that will change. And I think that also applies to M&A. When you're looking at the M&A, I may agree with or not agree with this or that. I may think, oh, that wasn't the best acquisition you guys have ever done or something. But we're not seeing the sort of gross overpaying for marginal assets that we saw in 2011, for example. We're not seeing that yet. So, no, I think it's a pretty good position. People are able to raise money. They're able to raise money without, for good purposes, whether it's an acquisition or development or whatever, but without excessive dilution. But that will change.
That will change, all right. Hey, Adrian, I would love to transition to the next topic, which is kind of this commodity supercycle thesis that some people have. We talked about currency debasement quite extensively earlier, and we have seen, at least reportedly, quite an underinvesting in mining and commodities, in recent decades. Do you believe that this is fueling a type of supercycle for commodity-wide, or should one view commodities on a case-by-case basis?
Yes. First of all, I don't like to use the term. I don't like to use the term commodity supercycle unless you're looking at a very specific, new demand factor that's entered the market. So, for example, you had a commodity supercycle after the Industrial Revolution in England and after the Napoleonic Wars, so 1815 to 1850. You had another supercycle when first Germany and then the US industrialized and grew, so from 1860, 1870 on to 1914. And then you had another supercycle with Japan, followed by the Asia Tigers, followed by China. So 2001 to 2011 was a supercycle because you had new demand come in from primarily China. But we're not at that situation at the moment, I don't think. I'm sorry, that was a little bit of a digression perhaps. But do I think that most of the commodities, or the commodity complex generally, do I think the commodity complex generally is very undervalued and could perform well over the next, 5-10 years? Absolutely, no question. You look at the both commodities and commodity stocks, they are trading at very, very close to 100-year lows relative to financial assets. I mean, that's just quite astonishing. And so they're certainly undervalued relative to the broader stock market. And I think we're at that turning point for the commodities. Having said that, I think that one has to be a lot more, you have to differentiate among the various commodities a lot more today than you did in 2001 or 1970, for example. So if you had huge demand start to come in from Indonesia and from Brazil, that would be a different question. All the commodities would move up. But right now, I think you have to differentiate a lot more. And the ones that I'm focusing on a lot more would be the ones, obviously price is always, determined by both supply and demand. And supply includes stockpiles. So stockpiles, supply and demand, and then you get your price. Obviously, both sides of that equation are important. But I am looking more right now at commodities, individual commodities, where there either is or there is a real, or there is a strong potential for a supply crunch. So, for example, iron ore, there is no shortage of iron ore. Now, there might be a shortage of the high-quality iron ore, but, if the demand becomes strong enough, people will forget the environmental issues and they will buy the dirty iron ore. there's no shortage of iron ore around. But when you come to something like copper and you look ahead 5 or 7 years, there is, on reasonable demand projections, there definitely is a supply deficit. Now, a supply deficit doesn't mean we won't have the copper to meet demand. It means the prices will go up to accommodate, to match the supply with the demand. So copper would definitely be one that we're looking at strongly. Uranium would be one. I think oil and gas is another one, because the oil and gas, the sentiment towards oil and gas is so negative, particularly oil. The sentiment is so negative. People think we're going to be, carbon free within 10 years, and it's just not going to happen. I mean, it's just plain not going to happen. So with the sentiment negative and the underinvestment, you were absolutely right, if I may say this, to mention the investment. Because with commodities, it's not an economic cycle, it's an investment cycle. And so you go through periods of overinvestment, followed by periods of oversupply, followed by periods of underinvestment. And those periods of underinvestment can last a long time. And during a period of underinvestment, because the lags between exploration and development to actually producing are so long, right? You can go through a period of gross underinvestment which does not show up immediately in a reduction of production. But over time, with underinvestment, you start to see production slow, but you have stockpiles from your overinvestment era, and those stockpiles are gradually diminished until then you have a period of lower production. And then the cycle reverses and starts again until you eventually get to overinvestment, and too many mines coming on and too much production. But again, the cycles being so long, it doesn't show up immediately, but you have that turn in investment. But again, as I said at the beginning of that little speech, the cycle is an investment cycle, which doesn't correspond directly with an economic cycle. So I think we are now moving into a period where the incredible underinvestment that we had across the board, from like 2012-13 all the way through to 2017-18-19, gross underinvestment, that is now beginning to be felt in the production. And so I think the timing is absolutely right for the commodities generally. And I think they'll all do well. It's just that some will do better than others.
Incredibly interesting, Adrian. And something that you outlined there, of course, with oil and gas, for example, that investment cycle doesn't necessarily need to line up with the economic cycle. Of course, they interplay and they can mix, but we've had historically recessions with high oil prices.
Well, absolutely. And if oil will tend to do very well in a recession, but particularly in a stagflationary period. So you have inflation and a sluggish economy, and the oil price can often do well in that environment. But I think the thing about the oil is the narrative, the underinvestment has been so extreme because of both the narrative that we're going to do away with oil, in 10 years' time, and also because so many investors and funds, particularly more so in Europe than in the US, but so many will not invest in that sector. And so we've got the situation where oil and gas companies, until very recently, but were continuing to produce good cash flow, were not reinvesting it at all. Why reinvest in something that nobody wants? And so instead they were just paying out in dividends, which was okay for the investors who held the stock, but there was no reinvestment going on. So I think we're going to come to a point, and we could come to that point pretty soon, where the chickens come home to roost, as it were. And in particular, if you look at the oil market over the last, say, let's say over the last 100 or let's say over the last 80 years, every so often you get a new source of demand, a new source of supply, I'm sorry. It might have been the big fields in Venezuela and Mexico, and then which are now, in Mexico's case, are now depleting. It might be the North Sea oil, which of course gave a huge boost in the 80s and early 90s. Gave a huge boost to oil demand, but those things, I mean, they're continuing, but the tail is maybe long, but very, very low compared with where production was at the peak. And of course, over the last 10 years, the big new source of production were the US shale fields. So over the last 5 years, the US shale represented more than 100% of the entire growth in global oil. Right? The growth in oil all came from shale. But shale has peaked. Most of the fields in the US have peaked and are rolling over. We don't know how long those tails will be. We don't know. There's a lot of suggestion and evidence that the tails on shale will be a lot flatter, shorter than they are for traditional fields. But nonetheless, I think it's fair to say we don't know. But the important point is that all of these fields have peaked and are rolling over. And so that source of supply growth will not be there anymore. Now, what will replace it? I don't know. Something will at some point. But at the moment, it means the production is going to be pretty stagnant.
Adrian, so many more threads to pull, but of course we're slowly running out of time. I would love for you to talk about Adrian Day Asset Management.
Oh, well, that's very kind. Thank you. So Adrian Day Asset Management, we manage money for clients, individuals as well as small institutions. We are global managers, so we invest, around the world in pretty much. I like to say I'll invest in anything I understand. That means I don't invest in technology or biotech, but I'll invest in anything that I understand, and we invest globally. We do have dedicated gold accounts, dedicated resource accounts. Accounts can be tailored, individualized for a person who wants gold but wants to be conservative or whatever. And the place to find information on that, we're not head up with minimums. We want minimums that make sense for the client, meaning we don't want a guy with $100 million giving us 20,000. But we're flexible on minimums, and the place to go for more information will be adrianday.com.
Perfect. Thank you so much, Adrian. Like I said, so many threads to pull, but hopefully we can have you back on soon.
Well, I'd love to. Thank you so much. Yeah, that went quickly.
That definitely did. Adrian Day, thank you so much for your time. Really appreciate it.
Thank you.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.